Let's begin first this edition of India Tonight by talking about what went down on the last street today by way of trading action. We've ended 5 consecutive days of gain. The Nifty has ended flat today, but it still ended above 17,600. Among the stocks that were in focus, definitely Tata Motors is one. Also ONGC and Grasim. These were the top gainers among stocks. But sectorally speaking, it was the real estate fact that really grabbed attention. Meanwhile, the Bank Nifty has closed in the red. It closed below 40,000. And in the broader markets, we've seen both the small cap and the mid cap indices continue to gain momentum in trade today as well. But let's get further perspective on what happened as far as trade is concerned this Monday on the Large Street. Anisha Jain, my colleague, is here to walk us through the highlights. Anisha, at the end of trade today, how did we look?
Well, off the trading highs, that's how we ended the trading session because Nifty managed to just hold on to that 17,600 mark, and the massive underperformance was actually coming in from the banking space because that index lost almost 200 points in the trading session. So that was the key laggard. Other than that, the broader markets were outperforming a tad bit because the mid-cap index and small-cap index managed to eke out small gains. But sectorally speaking, it was real estate all the way in the trading session today. So a 4% gain coming in, and of course the gains were led by the likes of Godrej Properties. Then you had also a DLF, a prestigious state, and they were all excited by the updates that we have seen coming in from some of these companies like Sobha, Godrej Properties, etc. What also did well in the trading session today was some of these oil and gas names. So ONGC was up a good 4% as the credit power recommendations have been accepted, and then the likes of IGL and MGL were trading at 52-week highs. You also had names like Tata Motors, which was definitely in action today. So a 6% gain coming in after the GLR UK sales were quite strong, and the cash generation was also better than what the street was penciling in, and the rest of the auto space also followed suit. What did not do well today? Well, select names coming in from the banking names as we pointed out, and then consumption. So HUL, Tata Consumers, Asian Paints. These were some of your top losers at the index level. From the broader market, some of the chemical names did well. So Rosari Biotech as well as names like Aarti Drugs, etc. were in focus. On the losing side, you had names like Symphony, which was down in the trading session, Orient Electric. So very broad moves, but auto, IT as well as real estate, definitely the outperformers today.
And we've been speaking, Anisha, to a lot of market experts, among them Samir Arora, who's the founder and fund manager at Helios Capital. Samir Arora believes that India is a big beneficiary right now because we are seeing global volatility. So within that, India stands out. He's also expecting a double-digit return this year. Listen in.
I expect this year to be positive and double-digit positive. And some of it got delayed a little bit because I was expecting the US to have settled down when I was saying this end of last year, and that has got delayed a little bit. But broadly, you are absolutely right that the worst is over and things are stabilizing, and India is, even though in performance-wise has done badly, we can say, but and that is related to China and others. But every day, if you see books, if you see discussions, if you see Twitter, if you see economists cover, everywhere this issue of China versus US is heating up, and that has a big influence on big picture flows into China and corporates going into China and everything associated with it. And India is a beneficiary on that big picture theme for, it'll be a beneficiary for I think many years, but on the margin a big deal for India.
Samir, so can we assume that the local crisis, which was largely because of Adani and trade deficit, that's behind us, and global crisis, which was largely because of inflation and US regional banks, that's also over?
I would think out of these, what is happening to the US banks in theory, I don't think is over. We are hoping that the system can handle it because the actual losses in terms of mark-to-market losses and what percentage they are of US banks and particularly smaller banks and regional banks, that number may be quite high, which basically means that the system has to remain in stable conditions so that there is no panic triggered by these things. I think that is one angle on which I don't have a strong handle as to how to do it beyond just being a strong, that means for the Federal Reserve or for the FDIC and others, to be signaling that they are anyway there for any bank that needs their help. Other things I think are over or getting over.
So Samir Arora is not quite sure about the banking crisis, whether the worst of that is behind us or not, but he definitely sees good growth as far as the Indian story. But of course, as far as capital flows go, relations between the US and China are going to come into play, is what he said. But talking about what the future is looking like, now we're going to kick off our earnings season. Q4 earnings season is upon us. What's in store this time? Will earnings growth sustain or not? Let's connect with our research team. Sharad is joining us from there to tell us where expectations are pegged. Sharad, how is it looking?
Well, yes, the fourth quarter of FY23 would be in focus as the overall quarterly EPS for Nifty is expected to remain at elevated levels. And do remember, it's expected to come in at more than 220 rupees per share per mark. And the important thing is this entire inflation cooling off will actually boost the EPS numbers going ahead. But let's look at the hardline numbers. The number is 220 rupees per share with almost an implied growth of 3% if you compare it with the Q3 numbers. Now going ahead also for the first quarter FY24 also is expected to rise as high as 9%. So that is something which we'll be watching out for. And of course the EPS growth is on an upward trajectory. Apart from that, which are the important stocks over the next 3 months itself will have the highest EPS growth? And of course, to making in the list in this Nifty space is Kotak Mahindra Bank with almost 18% growth, and also this applies for UPL and Coal India. This is closely followed by ONGC and SBI as well. But apart from this, if you just look at how the performance has been over the Nifty earnings over the last 5 quarters, we see the above numbers which have come in have actually come down below 20 companies in the last quarter which had reported. But do remember the inline set of numbers have been reported, and that this time in the third quarter itself it has gone more than 50% of the total Nifty stocks. Now looking at the important thing is the valuations part, and over here we see for FY23 it's almost at 18.5 times, but going ahead is expected to go to almost 17 times in the next 2 years. Apart from the valuations, the EPS is actually in focus, and do remember when the year had started FY23 it was around 837 rupees. It went up to almost 847 rupees after the fourth quarter of FY22, but currently as on 31st March it stands at 830 rupees per share.
Thanks for that, Sharad. That paints us a picture of what we can expect. Of course, the proof of the pudding is in those numbers that come in, and earnings season is going to quickly unroll, and we'll be on top of the game for you. But meanwhile, it seems like recession fears have taken over investor sentiment in the United States. Wall Street has opened in the red for the week. It has been doing a bit of a yo-yo, but right now it seems like it's all red as we speak. The Dow Jones is seesawing, and now we're seeing it down about 0.01%, very marginally in the red at the moment. The tech-heavy Nasdaq is taking a cut of around 1%, and S&P 500 is down more than 0.5% as we speak. A key macro factor that investors are watching out for this week is inflation data, and that is due 12th of April. Some stock-specific action also. Apple and Alphabet, these stocks have slid in trade. Tesla stock is in focus. It has announced price cuts for some electric vehicles, but it has managed some marginal gains. So we'll keep watching out for those stocks as well as it wears along. But what about the commodity markets? We got in a word from Peter Maguire, the Chief Executive Officer at XM Australia, who believes that we could see an upside on gold. He also says that crypto seem to have better days ahead now following all the volatility that we've experienced in recent times on the crypto front. This is what we got from Peter Maguire.
I think it was oversold, and I feel as though that the best days are ahead as far as crypto.
Really?
Oh yes, definitely. They're back at 28,000, and the overall momentum I think will be to the upside maybe later on this year. There's a lot of uncertainty. You've got different payment systems that banks are looking at as far as centralised digital and of course decentralised, and the other side is countries asking for payment of commodities or goods other than the petrodollar. So I think that there's going to be, again, a fractured mindset. It's going to be incredible how it plays out. And as an observer looking in, I think volatility again across crypto and currencies is going to be incredible. I don't think it's run its course. I think its best days are again ahead of it. And I think how it trades over the next 18 months is going to be electric. I wouldn't be surprised to see big whipsaws, and I won't be surprised to see it up from here considerably. I don't know what that number is going to be, but I think the overall momentum, central banks buying, geopolitical concerns, there's a lot of pluses playing into gold's picture and its basket.
Gold is an interesting play right now, looking at the way prices have been zooming. Crude oil prices are on the rise, oil is on the boil, and that's something that we are tracking very closely. But yes, bringing the action back home, I was telling you about earnings season. One stock that is catching our fancy is Tata Motors. Now, the company has shared those updates for its JLR arm, and those sales numbers have gone up for the fourth quarter. It's happened on the back of improving semiconductor supply. Tata Motors is also seeing growth in its wholesale business. So let's get an overall sense of where things are headed for Tata Motors. And for that, my colleague Srishti is joining us. Srishti, Tata Motors Q4 update. We've been sharing with our viewers. Do put that in context against expectations on those Q4 numbers and how the stock is likely to do. What are you picking up?
Yes, absolutely. Tata Motors is seen to be riding fast, and that's after a robust sales update coming in from their JLR division in the quarter gone by, where their wholesales as well as retail saw an uptick anywhere between 19 to 21% on a sequential basis. But not just that, the key to note was the free cash flow number being posted by the company, where in Q4 the company expects their free cash flow number to be over 800 million pounds, and that will be a raise against 490 million pounds recorded in the Q3 earnings. But not just that, if we look at the full year of FY23, then they are expecting a positive number to be over 500 million pounds, and that's a big positive coming in from Tata Motors, because that clears the way that going ahead the company can utilize its cash to deleverage. It's what the company management has also been guiding out for. So that's the big news coming in from Tata Motors. And after this particular update, the stock has seen upgrade coming in from the brokerage houses as well, wherein firstly talking about BofA, they maintain their buy rating for a target price of 475 rupees. They say that the solid ramp up at JLR booking run rate has been better than expecting, sprinting on the balance sheet deleveraging plan, and they see a key case for accelerated deleveraging ahead, and that's BofA's take on Tata Motors. But Goldman Sachs has gone ahead and upgraded the rating to a buy from a neutral rating earlier, raised the target price to 550 rupees, and they've also listed a FY24-25 EBITDA estimate by 15 to 16%, and they are of the view that the market is underestimating JLR EBIT margin potential. And on the back of these positive news flow, Tata Motors is already seen to be buzzing. Back to you.
Indeed, a 5.5% kind of up move on that particular account. Thanks for that, Srishti. Let's talk about this big deal as far as Neogen Chemicals is concerned. Now, they've announced this tech transfer agreement with the Japanese major MU Ionic Solutions Corp. They're obtaining the license to manufacture electrolytes in India. That deal is likely to help meet India's lithium-ion cell demand, and this through MU technology. And for this, Neogen has planned for a maximum installed capacity of up to 30,000 metric tons per year. This deal is quite important. It's the first time that the Japanese company has approved a license for any contender around the world. It's the very first. It makes Neogen the first company to manufacture electrolytes with an MUIS license. This is what we got from Hiranandani. He's the managing director of Neogen Chemicals. We were speaking to him about this deal. This is what he told us.
We've been entering into an agreement between Neogen and MUIS. So MUIS, it's a landmark agreement. So MUIS stands for MU Ionic Solutions Corporation Japan. It's a subsidiary of Mitsubishi Corporation. And this is going to be a first license worldwide given by MUIS to anybody in the world. So Neogen is the first proud recipient of this license. And this is for manufacturing technology for electrolytes in India. So this is going to be a license to manufacture electrolyte materials globally. They will be supplying their globally acclaimed technology and plant design. This will support up to capacity of 30,000 metric tons per annum. So this will support approximately 30 gigawatt hour of batteries.
All right, so that's what we got from the man of the moment as far as this landmark agreement is concerned, the transfer of technology, and we'll see how this ups our lithium-ion manufacturing capacity. Moreover, we are hearing about these hopes rising for lenders. They are rising once again to resolve the 20,000 crore rupee bad debt of future retail. We're learning from sources here on ET Now that so far, 49 bids have come in into the second round of bids, and this includes bids of Reliance Retail, the Adani Group joint venture, JC Flowers and Jindal Power, of course, among others. Let's find out more about this from my colleague Ankur Mishra. So lenders seem to be in a happier space. It's a 20,000 crore rupee bad debt of Future Retail. Now where do things stand, Ankur?
Yes, as many as 49 bids have come so far as an expression of interest for acquiring Future Retail. Now in the last round, there were few applications. In fact, 16 EOIs were submitted for the company, but no one turned up when there was a time for submission of final bid. Now in the second round, and lenders had invited bids, there are as many as 49 applications, and the big names are there once again, which includes Reliance Retail, Adani Group JV, there is a name of Jindal Power too, and also JC Flowers Asset Reconstruction Company, among others, which have submitted expression of interest for acquiring Future Retail. Now, as far as the conditions are concerned, the companies can acquire the company in full or in parts. Few of the clusters which has been identified by the lenders, that can be a criteria for the companies to submit a bid for the company. Now many of the scrap companies have also submitted name for submitted bid for Future Retail, and apart from that it also includes many of the ARC companies. Overall, the deadline for submission of final bids is 15th of May, and after that the final resolution applicant will be decided by the lenders. As far as the total debt of the company is concerned, it is around rupees 20,000 crore, and Union Bank of India, Bank of Baroda are among the lead creditors who has an exposure of over rupees 2,000 crore.
Of course, like we've been telling you, the final bids are going to come in by the 15th of May. So 49 bids so far. How much further we'll go? We'll keep tracking that. Ankur, many thanks for that. Now, one sector that I was telling you has been drawing a lot of attention today as far as the action on the last street is concerned is the real estate pack. Stocks were on an uptrend, and this given the certain tailwinds we've been talking about. Among them, of course, the RBI's move to hit the pause button on that repo rate hike this time. What remains to be seen, of course, is how this is going to impact the demand of home buyers in days to come. But companies are seeing a record number of sales in FY23 so far. Let's understand those numbers, sales numbers. Vamakshi, my colleague, has been poring over the data and she's painting us that picture. Vamakshi, do tell us how the sector is looking overall right now when we've hit that pause button on interest rate hikes.
It has turned out to be a record year for real estate players. Let's first start off with Macrotech developers. Now the company has reported pre-sales in FY23, and in fact they've surpassed their guidance of around 11,500 crores. In fact, it also happens to be the third consecutive quarter where the company has clocked in pre-sales of over 3,000 crores. Now as far as Godrej Properties is concerned, their annual booking is nearly 22% ahead of their full year guidance. In fact, they're targeting pre-sales of nearly 20,000 crores by FY26. As far as Sobha is concerned, they forayed into the Hyderabad real estate market in the fourth quarter, and in the fourth quarter itself, the average price realization has also seen an improvement of nearly 20% year-on-year. Ajmera Realty is also in focus as the company has aims to double its launch pipeline in FY24 given the good momentum that they're seeing in sales, and in fact they're targeting 2,000 crores of gross sales. So overall a strong operational update so far, but it is also interesting to note that developers have managed to sustain pre-sales in the last 6 quarters. Now, as per a recent report by Avendus Spark, aggregate pre-sales have reached between 10,000 to around 12,000 crores for companies within their coverage. But at the same time, in the last 6 months, realty stocks have definitely taken a beating, with stocks such as Sobha as well as India Bulls declining by over 20%. Other counters like Phoenix Mills, Macrotech developers as well as Prestige Real Estate is also seen under pressure. Apart from that, this fall has, when we look at it, this fall has in turn led to valuations falling below or staying at par with the 2-year average. But going ahead, we're seeing a lot of tailwinds for the sector. Repo rate has remained unchanged, which is a welcome respite to home buyers. Q1 2023 end housing inventory is down to 20 months from 42 months that was seen in 2018 as per ANROC, and this in fact is the lowest inventory overhang in the last 5 years. Luxury home sales are also seen boosting revenue, and this segment particularly is seen performing well as well. Apart from that, rising rentals are are also expected to incentivize home purchases. So going ahead, the going seems really strong for most real estate players.
All right, Vamakshi, that's a picture as far as sales are concerned in FY23. Now, the real question to ask right now is, now that we are poised at the start of a new fiscal, are these kind of sales going to sustain or not? And to answer that question, let's connect with an industry voice. Mr. Niranjan Hiranandani is chairman of Hiranandani Group, and it's always a pleasure talking to him. Great to have you with us this evening, Mr. Hiranandani. You know, the effect of the pandemic, sir, was huge on the real estate sector. How do you see the pickup in sales right now as is being reported? And this across the major property hubs of, the metros, the tier 1, tier 2 cities. How are they doing now that we have the potential tailwind of a pause in interest rate hikes by the RBI and a possible kind of fillip to the real estate sector? Do you think these numbers can be sustained?
Vikram, I'm seeing a very good year to continue in 23. The calendar year looks extremely exciting, and the next 9 months is probably going to see a 10 to 15% hike in total sales across the board. Housing finance companies, banks which are lending to retail home loans have increased their amount of lending by also about 12 to 15% on an average. This itself indicates that there is a buying. However, there has been a setback, Vikram, if I may point out, that the growth in the case of the affordable segment, for the first time in my lifetime, I've seen a slower growth in the affordable segment as distinguished from the mid and the higher end segment. So really the growth story, if the interest rates fall down in the future, I think the growth in the affordable segment will again pick up, which means the overall sale over 23, 24 could be much higher if ultimately the interest rates actually start moving down, maybe in 3 months or 6 months' time. We hope that the system will change. So 23-24 is going to see a boom year for real estate is concerned, a 15% growth across the board. And housing finance companies, Vikram, are very interested to lend more to retail home loans because the NPAs in retail home loans have fallen to less than 1.5% across the board of all the companies, which is the lowest NPA in any sector whatsoever of lending that takes place in the financing sector. So all in all, looks like a positive boom year in the next 12 months.
So besides the interest rates, what are the real factors at play, Mr. Hiranandani, this time around? If you're going to see a boom year, what's really going to drive it? What are you seeing in the trends that are playing out? Because like you said, in affordable, we haven't seen that much of a party really. And for that, interest rates need to come down. Whether or not that happens remains to be seen. But at this point in time, when you're watching the trends on sales, what's really going to drive it if you're calling it a boom year?
So, Vikram, I see the overall economy is looking extremely positive. So, we are doing that, except for there is one hesitancy of some people to close into the market is the fact of anticipated job losses in some of the sectors. So, people in those areas where they think that the job losses could be there could hesitate to actually close transaction. But on the other hand, we have to see that the number of jobs which are now coming up are shooting back again. Even in the real estate sector, the number of jobs which are taking place, the number of startup operation of new projects being launched are also seen to be increased. And in the next 30 to 60 days, you'll see all the top players, which you have now mentioned, are doing new launches this year. One more factor which I've seen, Vikram, happen into the marketplace is a larger amount of consolidation in this field. So branded players are now taking a bigger proportion of the total market than earlier too. So people are more relying on branded players, people who are actually performing and delivering, and they want a trust factor to do it. So anticipation there. And of course, in the higher segment, we have seen unprecedented sales, which had never taken before. So I think after COVID, people have started valuing their homes much more. Having stayed at home for 6, 12, 18 months, depending on the type of industry they are doing, people find it worthwhile to invest a little more in a little bigger house, in a better quality house. So they're willing to spend a little more. So while the number of transactions have gone up, but the transaction in the mid and higher sector have gone up faster, and hence you see the overall top number, Vikram, is much higher.
So as an asset class, Mr. Hiranandani, how is real estate really panning out? Because we are at a time when we are seeing a lot of volatility in the markets. We are seeing certain stoppages in SIPs as well. And part of the reason could be that, the kind of returns that you get in the markets could have plateaued. So when it comes to investments into real estate, and like you said, people are seeing value in putting in money into real estate, and perhaps that's what's reflecting in sales. Also, it has to kind of show in the kind of rentals that real estate can draw, right? Whether it's residential or commercial. How is it looking on that front?
So, Vikram, to say the interest in the commercial real estate, you're getting not only local players, but international investors are going hungo onto it. So you're seeing much more investment come into the commercial real estate. However, the returns on the rental real estate and real estate rentals has gone up, but not as much, Vikram, as I was thinking would happen. So the rentals are still averaged out. They have gone up by 5 to 10%, but not more than that. And except in certain locations where demand has suddenly gone up, both in the lower segment also demand. So for example, in our project in Oregon, where we have the lower income levels of people already because of the industrial area, the rental in terms of it may not have gone up much, but the demand has gone up tremendously. So while the value of rentals still continue to be 3 to 4% at the most in residential, you are getting 6 to 7% plus in the case of commercial. Hence, foreign investors are looking more at commercial than residential. And that will continue to stay because I think they are more comfortable with the commercial side than the residential side. But I feel that rentals, as far as our company is also concerned, we do go in for some portion of the residential to be also given on rental, which we never did before. So I do see that some of us would be taking up residential for rental also.
You did mention the importance of branded players drawing that much more traction. At this time, as far as players within the real estate sector like yourself are concerned, how are margins looking? And do you think you'll be able to sustain these margins if you have to see sales getting pushed up? Because costs are always a concern, and input costs, we are seeing oil prices rise as well. Is that going to have a bearing? If we can get that answer from you very quickly, because we are running out of time, Mr. Hiranandani.
That's a fear which I don't know that I could give you a correct answer.
Sure.
The future are yet to see. But we do see a challenge in terms of costs of the inflation is certainly eating into the profits, and that's a challenge definitely for all the companies that we see, those who are doing the booking in terms of it, because delivery is 2 years forward. So the cost increases definitely have to be absorbed. So margins could be hit. But at this point of time, the margins are comfortable. But the future would be extremely difficult to predict as inflation rates could increase again. We don't know for sure.
Those insights are always very valuable, Mr. Hiranandani. It's always a pleasure speaking to you and getting your perspective on all things related to real estate. Thanks very much for joining us on this edition of India Tonight.
Thank you.
Meanwhile, we've got breaking news coming in. The Election Commission of India has recognized the Aam Aadmi Party. AAP has been recognized as a national party. Meanwhile, losing that status is the CPI and also Mamata Banerjee's Trinamool Congress. Both of these parties have lost their status as a national political party. What's the criteria really for being a national party, and what are the implications of these decisions by the Election Commission? Let's find out. My colleague Tamanna Inamdar is joining us from our studios here in Mumbai. Tamanna, do tell us the significance of these moves being made by the Election Commission when it comes to Aam Aadmi Party, the CPI, and of course, we're looking at Trinamool Congress also losing its status as a national party.
So it's a big announcement that has been made by the Election Commission, and just to give you a quick backdrop of this, this is something that the Election Commission has been contemplating since the last general election of 2019. after which there needed to be a review of the 8 national parties in the country. Now, what is the criteria of being a national party, and why have these particular parties lost their recognition as a national party? Why has Aam Aadmi Party now been given that recognition? So the set criteria includes that this party must have at least 6% vote share in the Lok Sabha elections, or 4 Lok Sabha seats, or they must have at least 6% vote share in 4 states in the country in assembly elections. The other criteria is that they should at least have 2% of vote share in 3 states in the Lok Sabha. So it's either the first or the second. The third criteria, which will get you official recognition as a national party if you're a political party, is that you have recognition as a state election party in at least 4 states in the country. Now, what is the implication of this is the big question. Does this mean that these parties cannot fight in the next Lok Sabha election? No, they absolutely can. So the TMC, NCP, CPI, which have been de-recognized, will be able to fight in 2024. What they lose out on, apart from the official recognition of being a national party, is the ability to retain a single and permanent election symbol across all states. And that's very, very important, because every party is recognized at the end of the day on the ballot box on the basis of their symbol. The other thing that they don't get will be free campaign slots on national broadcasters ahead of the next general election. They also lose the right to a party office in New Delhi, in the capital. And while national parties can have 40 star campaigners, those that don't have national party status can have 20 star campaigners. Now remember, this is the first step of the Election Commission having de-recognized these parties. Good news for Aam Aadmi Party, which has now made the cut based on these criteria. We'll have to wait and see what responses come in from those parties that have been de-recognized.
All right, thanks very much, Tamanna. We needed to put that in perspective, and that's exactly what you've done. We'll keep tracking developments on this. But meanwhile, we've got this Financial Times report which accuses the Adani Group of relying on foreign funding, and the sources of foreign funding have been questioned. That report says that the Adani empire relies on offshore funding. The group has hit back now, and a clarification has come in. In its hit back, they've accused the London report of politicizing the group's business. The business group has also said that its promoters have reinvested funds for growth, and that the report itself is false and full of damaging insinuations. Let's get market perspective on this. Vinit Bolinjkar is head of research at Ventura Securities, and he's joining us on this edition of India Tonight. Sir, it's good to have you with us. This FT article that we're talking about is being referred to, and it has said within that article that a quarter of the FDI that flows into the Adani Group of companies has come from connected shell companies through a series of small and frequent investments, like they say. And more recently, the transactions have become larger and less recurrent, is also something that the article says. Through your own research, sir, how much truth did you find in that FT article? How damaging do you think this article is to Adani Group that speaks of round-tripping of funds from shell companies based in Mauritius?
So, I think it's just regurgitating unsubstantiated claims by the Financial Times article. So what we need to understand is, they are talking in taking into consideration $2.7 billion of funding, which they claim has been coming from dubious sources. So the first thing is, this refers to transactions between Adani Green and the Total Group, and Adani Gas and again the Total Group. If we talk about the Adani Green transaction, it was a $2 billion transaction done directly between the promoters' foreign companies with that of Total. Now you have to understand that when you undertake a share transfer, obviously the shareholding will get it's all dematerialized, and so it would be obviously be reported. And so, you cannot hide this. And they have already done the disclosure to that extent. Now, if you take the other deal of some $783 million, which was done again with the Total Group, some 70% of it was done by the foreign arm and 30% was done by the domestic entities of the Adani Group, right? And all this money that they have received, they have invested as growth capital in various group entities from time to time. Now, the allegation that they are doing is that these transactions are not reported. But if you were to refer to the tweet of Jukishinder Singh Robbie, he has clearly, highlighted the fact with substantiated claims with, SEBI and stock exchange filings that all these transactions are all above board. They're clear, they're transparent, and there is nothing to hide in them. Another thing that we need to look at is that, this $2.5 billion investment itself was published by the Financial Times some time back, and the same has been corroborated by Robbie in his tweets that he has put out. Also, regarding the DONE transaction, I said, they filed, they filed their papers to show that, they were well reported on time, accurately, and to the extent it was transparent.
Yes.
So considering all these facts, I believe that, there is a insinuation to kind of keep raking up the issue.
Yes.
But I think the damage has been done and the market is taking cognizance of these facts.
Yes.
And anything that follows will just be kind of, lower impact of the verbose regurgitation.
Well, it does follow, this FT piece does follow on the heels of that Hindenburg report, which was damaging. What's the sense that you derive about the impact it's going to have on Adani Group stocks right now as they are poised? Some of them could be more susceptible than others in terms of its fundraising ability as well. Do you think that is going to be a point of bother for the group?
See, already the group has faced a lot of flack and they had to indulge in a lot of fighting to raise resources to bolster their personal balance sheets of the group as well as the growth capital for the group. Now, the thing is that, multiple impacts of this Hindenburg report have meant that growth capital, both debt and equity, is scarce and coming. So what the group has done is they've gone to, repayment of all their existing debts, honoring commitments, and giving out a signal to the market that all is well, right? But investors who have been badly bitten by the misleading reports, they are not getting ready to tread into these waters unless, you have some kind of concrete evidence that, all is well. And from where will this come from? So I believe that the bill that has been filed in the Supreme Court, and to which extent the Supreme Court has set up a special investigation team who are supposed to wrap up their findings in about 2 months' time since then, or another 30 days from hence. I believe that will clear the air around this group. So far, what we have seen is that insinuations without substantial claims, and this has been countered with documentary evidence provided by the group. So, I am biased to, concur with the group that what they are saying is the truth. And unless and until the insinuating camp does not come out with documentary evidence to suggest what they are saying is the truth, there will always be an aspersion, in my opinion, with regards to the motives of these reports. So having said that, what I would advise investors is that wait for another 30 days, right? And let the Supreme Court SIT come out with its report. And once that is out, I'm quite confident that it will be in favor of the company.
Yes.
And that is when you should venture to buy into your stocks.
Meanwhile, the clarification that has come from the group has bolstered some of these stocks in terms of trade today. We've seen that happen.
Yes.
They have said they're not obscuring promoter ownership and financing. So in terms of the attempts being made by the conglomerate to control the damage, the fallout, when you hear the company say it's a competitive race to tear down the conglomerate, do you think they're doing enough to clear the air and to kind of bring back confidence in group stocks?
Actually, what I think that the international lobby is throwing darts in the blind, hoping to hit something from which then they can go further and do, get more kind of clues as to if something is really wrong. So they are just hitting in the dark, and I don't think the darts are falling off the dartboard, right? So unless and until this report comes, because it is by a body of respected individuals who will be taking data from RBI as well as the SEBI, which are very, very honorable and respectable regulatory bodies. So once this report is out, I think this will clear the mud which is slain on the group, and henceforth investors should venture into these companies once this report is out, so that you are in the clear of everything, and the group will emerge far much more stronger. There will be a lot of international as well as domestic confidence in the group, and I think from there the group will resume its high growth trajectory.
Fair enough. We'll keep watching the situation as it develops, and it has been developing over a period of time, one report after another, and there's a lot of firefighting that's happening from the group side as well. But thanks very much for joining us with your perspective on this, Vinit Bolinjkar. It's a pleasure talking to you on India Tonight. Hello again, you are back with us on this edition of India Tonight. Thanks for staying with us through the break. Now let's talk about online gaming again. It's something that has been on top of our minds. Now the group of ministers, the GOM, has been set up to review GST on online gaming, on casinos and horse racing, and that's likely to stay with 18% tax on gross gaming revenue. The group of ministers may recommend the highest 28% GST on betting, on casinos and horse racing is what we're picking up, differentiating between games of skill and games of chance. The group of ministers, the GOM, is expected to freeze its recommendations. This would happen only after the introduction of the IT Intermediary Amendment Rules of 2023. The final decision on this is going to be taken by the GST Council, and this is going to happen in its next meeting, which is going to be likely in the last week of May or the first week of June. Online gaming, which does not involve betting, it currently attracts 18% GST on gross gaming revenue. Nitish Mittersen is the founder and CEO of Nazara Technologies. He says that the new regulations to protect online gamers is a positive step, and he also says that 18% GST on GGR is going to be hugely positive. Here are his reasons.
Absolutely. I think what Mr. Rajiv Chandrasekhar released last week under MeitY is actually a game-changing, policy for the industry. I think two things have happened, right? One is, the government has recognized gaming formally as an industry and started giving guidance around it on how it has to operate. And I think that's a long way that the industry has come over the 2 decades that at least Nazara has been in business. So I think we are very excited about that. The second thing is the skill-based real money gaming space, right, has been the most monetized segment of the industry. But it has been surrounded over the years with a lot of gray area and unclarity on what is legal, what is not legal, what is a game of skill, what is gambling, how is taxation to be applied, etc. And this has prevented at least companies like ourselves to very aggressively invest in these gray areas. I think that is very rapidly changing, and the regulatory clarity that we have been asking for since many years is very fast emerging. In this budget, you had clarity on online TDS, which has come through, including the recent amendments. You have MeitY's gaming guidelines come through. I think the last cog in this wheel is the GST. And once that is also clear, I think the whole skill-based real money gaming space is ripe to take off. And Nazara is also going to make very aggressive moves in this space now that this clarity is emerging. So I think all around good news for the industry.
Well, that's one industry voice, and that industry voice is pretty upbeat about what's in store for online gaming in the country. But what the country needs to brace for right now, like I was telling you before the last break, is a monsoon that's going to be below par. Below normal monsoon is on the cards. A higher probability now of El Nino effect coming into play and becoming a dominant player in this monsoon. It's coming from SkyMet. We were speaking to GP Sharma, who's the president of SkyMet, who has decoded the outlook for the monsoon season for the rest of the year. Listen in to what he told us.
Monsoon had a good run for the last 4 years in a row. So it was almost expected also that, and in view of the El Nino conditions which are building up, it is quite likely that the monsoon is likely to be below normal. Below normal means, you see, the rainfall, anything between 96 to 104 is normal. Less than 96, it becomes a little below normal rainfall. Okay. So we are giving at the moment predicting that the monsoon is going to be below normal, and possibly it may not be that bad to start with. The beginning of the monsoon may be a little okay, but then halfway through the season we expect it to possibly go into a little a state of dormant, and then then the rainfall is possibly going to be less than in the second half of the season also. El Nino is the main player, is the spoiler of the monsoon as such, as the history dictates that El Nino conditions have resulted 80% of the occasions into below normal or even some drought conditions also. During the second half of the monsoon, the probability is lower. It's almost about rising more than 60%. So thereafter, possibly in the fall of the year or so, in the winter months, they will decline. But before that, there is no chance. It's growing, and it's growing phenomenally. I will say the rise is very, very rapid.
Well, that's what we got from Sky Met. So the possibility of a poor monsoon definitely on the cards, and we'll have to brace for that and its impact on the Indian economy as well. Meanwhile, India has denied UK media reports on the India-UK trade talks getting suspended. They've called the reports baseless. Earlier, UK media reported that India halted trade talks with the United Kingdom, and they will not restart these talks until UK publicly condemns a Sikh extremist group that attacked the Indian embassy building in London in the month of March. Also, Ukraine's first deputy foreign minister has been in New Delhi. She's on a 4-day visit to the country. It marks the first official visit of the East European country that is besieged. This is the first since the beginning of the Russia-Ukraine conflict that started last year. So during this India visit, the Ukrainian minister is expected to discuss bilateral relations, also exchange views on the current situation in Ukraine, and bring up global issues of mutual interest. In fact, she's also expected to call on the Minister of State for External Affairs and Culture, Meenakshi Lekhi, and meet with the Deputy National Security Advisor, Vikram Mishri, during this visit. But the focus has been on China as well. Now, China has sent more than dozens of warplanes towards Taiwan in what has been the third day of military drills. They've launched simulated attacks in retaliation to the island nation president's meeting with the U.S. House Speaker. Taiwan's defense ministry has said it is monitoring the movements of China's missile forces. The Americans are saying that it is on alert. Taiwan too has retaliated by holding drills with tanks, with armored vehicles. Remember, China is holding these live fire drills to round off 3 days of military exercises in response to Taiwan's president meeting with the U.S. House Speaker. And there's another reason that's closer home why China has been in the news. China has gone ahead and criticized Home Minister Amit Shah's visit to Arunachal Pradesh. China is stating that it violated Chinese sovereignty. In response, the Home Minister Amit Shah has said that nobody can take an inch of India's land. China's reaction is not new, of course, but it must be seen in the context of its souring relations with the United States. But listen in to what the Home Minister has said on the comments coming in from China about his visit to Arunachal.
कोई भी हमारी सीमा पर आंख उठाकर देख नहीं सकता और आज हम गर्व के साथ कहते हैं वो जमाने चले गए जब भारत की भूमि का कोई अतिक्रमण कर सकता था आज 100 की सुई की नोक जितनी भूमि का भी अतिक्रमण कोई नहीं कर सकता क्योंकि आईटीबीपी और भारतीय सेना यहां पर उपस्थित है.
That's the capsule I was talking about. As far as India Tonight goes, it's a show that you bring in every night to get a comprehensive sense of what went down in the business day. We'll do it through the week, every weeknight at 8 o'clock. I'm Vikram from me and the team. Thank you so much for joining us this evening. We'll see you same time tomorrow. Until then, do take good care of yourselves. Good night.